If you're 48 years old or at a similar age, earning somewhere around $750,000 in total compensation and have something like $2.8 million saved, this video is for you. You probably have been thinking about your exit for a while now. The vesting schedules, the bonus cycles, the quiet voice that keeps saying you don't have to do this forever. But every time you sit down to try to figure out when you could actually walk away, the math gets murky. The calculators give you different answers. Your advisor says one thing, your accountant says another. So you keep grinding through another quarter because at least that feels safe. Here's what most executives in your position don't realize. Your retirement date isn't just a lifestyle decision. It's one of the most powerful tax decisions of your financial life. And the year that you walk out for the last time could be worth multiple six figures. Today, I'm walking you through what we found when we built the financial plan for an executive in this exact position. A 48-year-old chief revenue officer with $2.8 million and a 5-year runway. The gap the basic math misses, the tax window that opens up the moment you exit, and every strategy that we used to make this work. I'm Dan Pascone, and I help corporate executives in their 40s and 50s design a hybrid retirement plan that makes work optional on their terms. So let's dig into today's situation. We'll call our client Ryan, and we'll lay this out the same way we did in a real planning session. Ryan came to us a few months ago. He's 48 years old, and he's a chief revenue officer at a publicly traded SaaS company. He joined right before they went public, and the vesting has been good to him. But Ryan is tired of 5:30 international check-ins, tired of weekend Slack messages, tired of running quota review meetings he could practically deliver in his sleep. His wife works, and he has kids in middle school and high school, and they've been talking about a sailing trip they've been wanting to take for years. He doesn't want to stop working entirely, but he does want to step away from the corporate grind at 53. And the question that he came to me with was simple. Does the math actually support it? Here's how we laid out the numbers. Total compensation of roughly $750K, which includes salary, annual bonus, and RSUs vesting on a 4-year schedule. The goal is to step back from corporate 5 years from now with a target spend of $18K a month or $216K a year. We're planning to age 90, so it's a 37-year retirement horizon. And here's how his $2.8 million breaks down today. $1.6 million in his 401K and traditional IRA. $700K in his taxable brokerage account with meaningful embedded gains from years of RSU vesting and investing. $175K in a Roth IRA, and $225K in a non-qualified deferred compensation plan structured to start paying out at age 55 over 5 years, and $100K in a health savings account. On top of that, RSUs at approximately $150K over the next 5 years, so a total of $750K in equity comp between now and his exit. And his Social Security is estimated at $48,000 a year if he delays to age 70. So those are the basic inputs. Now, here's what Ryan was actually carrying when he sat down with me. Every quarter he stayed, either felt like he was being smart and prudent or burning daylight that he couldn't get back, and he didn't know which. And without a real answer, he kept defaulting to the safe choice. Stay one more year, vest one more chunk, wait for the next bonus. And that's the real cost of not having a plan. It's not just money on the table. It's years of your life spent grinding through optionality you already had but couldn't see. So let's look at what the unplanned version of this actually costs him. With 5 years of growth, continued 401k contributions, and RSUs vesting and being reinvested, Ryan arrives at 53 with roughly $3.9 million in investable assets, not counting the deferred comp. The shortcut that most people apply here is the 4% rule. And 4% of $3.9 million is $156K. But Ryan's target is $216,000 a year. That's a $60,000 gap right out of the gate. And that's not a rounding error. But here's what the 4% rule doesn't show you. Ryan is retiring at 53, and Medicare doesn't start until 65. That's a 12-year healthcare gap. And private coverage for a family at this income level can run at least $24,000 to $30,000 a year. Stack that on top of the spending gap, and the real initial shortfall is closer to $80,000 to $90K annually. The 4% rule also ignores how you draw from your accounts, when deferred comp pays out, when Social Security starts, and what a bad market in year one does to a portfolio with no liquidity structure behind it. Without a real plan, this portfolio could run into serious trouble in Ryan's early 70s. But with one, the picture is completely different. Before we get into the strategies, there's a foundational concept that I want to make sure you understand because it changes the way you think about Ryan's situation entirely. When Ryan is working at full comp, he has almost no control over his taxable income. His salary and bonus hits, his RSUs vest and are taxed as ordinary income at the highest federal tax brackets. And at his comp level, he's sitting in the 35 or 37% federal bracket. So the IRS is essentially a silent business partner, and Ryan doesn't get a vote. But the year he exits corporate, that changes. For the first time in his adult life, Ryan gets to choose how much ordinary income shows up on his return. He can draw from cash and after-tax accounts. He can realize long-term capital gains in years where his ordinary income is low. He can do Roth conversions, intentionally moving pre-tax dollars into Roth at brackets that he chooses. And that's what I call the tax control phase. Phase one are his W-2 years where he has low control and high withholding. Phase two is the post-exit window, high control and high leverage. Phase three is what happens after 73, when required minimum distributions kick in and the IRS starts forcing income again. For Ryan, exiting at 53 gives him potentially 20 years in phase two before RMDs start. That runway is an asset, and it's one most executives never quantify. And here's why it matters so much. In 2026, the 22% federal bracket starts at $100,000 in earned income for a married couple. And the 0% long-term capital gains rate applies up to roughly $99,000. Ryan went from paying 35 to 37% on every incremental dollar to having the ability to realize gains and convert pre-tax dollars at 22 to 24% or even lower in his early transition years. That delta, being able to convert at 24% or lower now versus being forced to take RMDs at 32 or 37%, can mean at least six figures over a 30-year horizon. And that's why the retirement date is a tax decision. And that's the lens that we use to build Ryan's entire plan. With the tax context established, here's the structural foundation that everything else sits on. The framework we use is called life-driven investing. Instead of starting with an asset allocation and hoping it holds up, we start with Ryan's life and build the portfolio backward. We organize his money into 4 liquidity bands, each tied to a specific window of time and with a specific job description. 0 to 2 years is your current needs, where we use cash and short-term instruments. At Ryan's retirement, this is roughly $480,000, 2 years of living expenses plus healthcare reserves. The money goes into high-yield, safe, and liquid instruments, so it's there when he needs it and is unfazed if the market drops. The 3 to 5 year band is for short-term goals, and for this, we use conservative, lower volatility investments. In this case, it's about $650K covering spending during the window before deferred comp starts paying out. The 6 to 10 year band are for his midterm goals, where we use a balanced growth portfolio. This is roughly $550K, carrying Ryan through the years after deferred comp winds down, but before Social Security kicks in. The 10-plus year band is his long-term growth bucket. This is where we allocate heavily into growth-focused equities and alternatives for added diversification. In Ryan's case, this is approximately $2.2 million, and think of it as the engine of the plan. This structure is what makes every strategy that I'm about to walk through actually work. Without it, you're making investment decisions. With it, every dollar has a job description tied to a date and a purpose. Strategy 1 is deferred compensation as an income bridge. Ryan's $225K deferred comp plan starts paying out at age 55, 2 years after he exits. That's $45K a year in guaranteed income from 55 to 60. That bridge changes the pressure on his investment portfolio during its most vulnerable window. Instead of drawing $216K a year from his investments, he's only drawing $171K. That reduction in portfolio withdrawal rate is significant, especially when paired with the liquidity bands, because it keeps him from selling growth assets at the wrong time. One important note: deferred comp carries real risk if it isn't properly built into your departure plan. And we see many executives, even if they don't have deferred comp, go and get some form of side income or produce their own income early in retirement to cover this bridge. In Ryan's case, the deferred comp payouts land squarely in his tax control phase, which means you can plan around that income to avoid being pushed into higher brackets. Strategy number 2 is the Roth conversion window. When Ryan exits at 53, his taxable income drops dramatically. No W-2, no RSU vesting, and deferred comp and Social Security haven't kicked in yet. For Ryan, that 2-year window from 53 to 55 is one of the most tax-efficient periods of his life. And we used it to convert roughly $200,000 from his pre-tax IRA and 401k into his Roth IRA. So he pays taxes on those conversions today at 22 or 24%. In exchange, those dollars grow tax-free with no required minimum distributions down the road. Once deferred comp kicks in at 55, and then again with Social Security at 70, his taxable income rises and his conversion window compresses. Over 20 years, a well-executed Roth strategy for a client with a $1.6 million pre-tax balance can reduce lifetime tax drag by well into 6 figures. But it's a finite window, so we have to make sure it isn't missed. Strategy 3 is RSU coordination before exit. Ryan has $150K in RSUs vesting per year over the next 5 years. That vesting is taxed as ordinary income at 35 to 37% and stacked right on top of his base and bonus. The default approach is vest, sell, pay the taxes, move on. We did something more structured. First, we laid in advanced tax loss harvesting from his taxable brokerage in years where his vesting and bonus overlapped, using embedded losses to offset vest income in the same year. Second, in years where income was lighter, we harvested more aggressively and deferred what we could in his taxable account rather than immediately recognizing everything. Third, and this is important, we coordinated the final year of vesting with his exit date. So his last vest happens inside his final working year. We modeled the timing carefully so he didn't experience a high income year in his first year of the tax control phase. Over 5 years, that coordination will save Ryan approximately $90,000 in taxes. And those are dollars that go to his retirement portfolio instead of to the IRS. Strategy 4 is ACA and healthcare as a tax lever. This one surprises most executives. Healthcare and Medicare isn't just a cost. For Ryan, it's a 12-year planning window, and it's also a tax lever. Premium tax credits under the ACA are tied to modified adjusted gross income under the federal poverty line. In years where Ryan manages his modified adjusted gross income carefully, which is exactly what the tax control phase allows, he can meaningfully reduce what his family pays for coverage. The key is not to stack Roth conversions and capital gains realizations in the same year without planning for how they will push up his MAGI. We sequenced his income carefully. In his early exit years, we prioritized larger Roth conversions. As deferred comp starts at age 55 and his income is higher, we will shift toward capital gains harvesting in lower income bands and pull back on conversions to stay below ACA thresholds. That kind of income sequencing, done across a 12-year window, can save tens of thousands in healthcare premiums alone. Step 5 is Social Security timing. Now, Ryan's default assumption was to claim Social Security at age 62. At that age, his benefit is roughly $30,000 a year. But if he waits to 72, it goes up to $48,000. That's $18K more a year, guaranteed, inflation adjusted for the rest of his life. Now, I want to be honest here. Social Security timing matters. But for Ryan specifically, it matters less than Roth conversion decisions and deferred comp coordination. I've worked with executives where delaying Social Security to age 70 has a major impact on the plan, but it's typically secondary to proper tax architecture. The plan isn't that you should always delay to 70. The point is that you should know exactly what each option is worth to your specific plan before you make the call. Ryan can afford to wait because the income sequence is designed. We have a short-term liquidity band, deferred comp, and a long-term growth portfolio that will cover his needs to age 70. Then when Social Security does kick in at age 70, it's providing a guaranteed income floor for the rest of his life, not filling a gap caused by poor planning. Strategy 6 is asset location and the health savings account. Where you hold an investment matters almost as much as what you hold. Income generating assets like bonds and dividend payers belong in pre-tax accounts where the tax drag is deferred. Growth-oriented equities belong in the Roth where they can grow and be withdrawn tax-free. Tax-efficient index funds or strategic tax loss harvesting portfolios belong in the taxable accounts. And Ryan's $100,000 HSA deserves specific mention here because the HSA is the only account in the tax code that is what I call triple tax advantage because contributions go in pre-tax, the growth is tax-free, and distributions come out tax-free if used for qualified medical expenses. We invested the balance in a growth-oriented allocation and designed it specifically to manage healthcare costs during the 12-year Medicare gap. That's a dedicated, tax-optimized pool for one of the biggest hidden costs in an early retirement. Now, a plan that works only in good markets isn't a plan. So here's what we tested. The market drops 30% in year 2. This is the scenario that ends under-planned retirements. Ryan steps back, he feels good about the plan, and then the market drops. And if he's drawing income from a growth portfolio at the time, then he's locking in losses permanently. For Ryan, the liquidity band structure manages this risk because his 0 to 2 year band is in cash and cash equivalents, and his 3 to 5 year band is in short duration, lower volatility instruments. So despite the market drop, he just draws from those pre-funded bands. And the growth portfolio sits untouched, it recovers, and he never sells at the bottom. This is what properly structured sequence of returns defense looks like in practice. Now let's talk about RMD pressure at age 73, because this is a risk that most people don't model. If Ryan hadn't executed Roth conversions during the tax control phase, his pre-tax balance would have continued to grow. And at 73, the IRS would force distributions at whatever bracket applies to a much larger balance. But with the conversions in place, the pre-tax balance is meaningfully smaller, which means that RMDs are reduced and the tax bite is manageable. The Roth runway we built from 53 to 55 shows up in real dollars at age 73 and beyond. So, can Ryan step away at 53, starting with $2.8 million and spending $18K a month in retirement? The answer is yes, with the right architecture behind it. And while the numbers may vary, here are 3 concepts that will determine whether or not you're in the same position. Number 1, your retirement date is a tax decision, not just a lifestyle decision. Because the year you exit determines how long you have to control your taxable income before the IRS begins mandating it again through Social Security and RMDs. For Ryan, exiting at 53 versus 58 isn't just 5 more years of freedom, it's potentially 5 more years of Roth conversion runway, 5 more years of ACA leverage, and a meaningfully smaller pre-tax balance by age 73. Number 2, your equity comp, your deferred comp or self-generated income, and tax decisions need to be coordinated across multiple years. RSU vesting schedules, deferred comp payout timing, Roth conversion windows, Social Security delay, capital gains harvesting, all mapped together. That's where high-earning executives either build a structural advantage or leave multiple 6 figures on the table. Number 3, your money has to be organized around when you actually need it, not just by account type, not by a generic risk number, by time horizon, matched to the specific dates that your life needs cash. And that's the difference between a portfolio and a plan. What Ryan walked away with wasn't just a retirement date. It was a clear model, a work optional target with real numbers behind it, a sequenced income plan tied to actual dates, a tax roadmap for the 3 major phases of his plan, and a portfolio organized around his life, not just a benchmark. So he stopped doing mental math and he started making decisions. And if you want to run this same exercise with your actual numbers, I'm happy to have a conversation. I call it a wealth clarity chat. We'll look at your actual comp structure, your timeline, your investments, and map out what your version of this plan could look like. It's free and the link to book is in the description. And if this was helpful, subscribe. Every video in this channel is built for executives who are serious about making work optional on their terms. I'll see you in the next one.